How much in taxes will I save by buying real estate this year? There's a few factors that I like to look at to see how much of a benefit someone will get from purchasing either more real estate, or really it's a specific type of real estate that they should look at in order to receive the full benefit. Here's my general framework of how that would look like. So the first thing we're going to look at is, what are your goals, what is your current portfolio, and what exactly are you trying to achieve? Are you trying to use depreciation to offset your income? If so, we want to look at a way how to treat your real estate as a non-passive activity. There's a few ways to do that, but of course we need to lay out all the options because there's pros and cons and a lot of nuances to each strategy. A phrase I commonly hear in the industry is called return on hassle. How much tax savings are you actually going to receive from this particular strategy, and how much work do you actually have to put into the strategy in order for it to work? So a great way to think about this is, we want to look for strategies that require less work but greater tax savings versus those that either have a lot of work with little tax savings. Are you going to be receiving a bunch of passive income this year? Are you going to be selling one of your properties that's going to trigger a passive 1231 gain? Maybe we need to acquire a new passive property to run a cost seg to run up those passive losses to offset that gain. Maybe you're going to be receiving a lot of income in the year, and maybe you want to shelter that money over into some type of business that has that component of real estate in it, such as short-term rentals, or maybe even a gas station or a car wash. A business that has that component of real estate that you can then drive up those losses and use those losses to offset some of the income. There's a few ways to look at it. And then remember, it's not just as simple as buying a piece of real estate. You have to look at things like real estate professional status as well as material participation. Those are huge components to it. Now let's just say you've already examined those factors, the passive activity loss limitations. We've already discussed that. We know that it's either passive or it's going to be non-passive. But then after that, we have to look at things like, how much of your purchase price is going to be allocated towards the building versus the land. Remember, the land is not depreciable, so the higher allocation we have towards the building, the higher amount of depreciation that we can actually get. And then as a bonus, whenever you get things like short-term rentals, you're gonna have fancy furnishings and fancy furniture, and maybe even some very nice landscaping and some land improvements such as a swimming pool. That can also really help drive up that bonus depreciation. Now, of course, the thing that you always have to consider whenever you're going to be doing a strategy that involves using depreciation to offset your income is, on the flip side, you have to look at depreciation recapture, because whenever you sell that asset, you will trigger that depreciation recapture. All the depreciation you previously took, you have to add it back as income. And remember, whenever you take deductions, you move from one tax rate down to a lower tax rate, but whenever you have to add it back, you move from a lower tax rate up to a larger tax rate. So you want to make sure that you always consider that whenever you're looking at depreciation recapture, and before that, bonus depreciation. A general rule of thumb on a rental property is you probably don't want to do a cost seg